Hey, before we get started with today's episode, I want to let you know that if you're planning for retirement or aren't sure where to start, we have a helpful checklist for you. We put together a guide called Your Pre-Retirement Checklist and have made it available for free on our website. This detailed checklist covers things pertaining to cash flow, Social Security, Medicare, asset allocation, and living a purposeful retirement. The link to download the checklist is listed in the episode description. Or you can go to wiserinvestor.com, scroll to the bottom, enter your email address, and then you'll have access to your pre-retirement checklist. Thanks for listening.
Welcome to a Wiser Retirement Podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, guiding you to financial freedom. It's my co-host today, Brad Lyons. Hey, Brad.
Hi, Casey.
Man, I tell you what, Brad, people are starting to get nervous about the stock market. We've put out two emails in the last week and a half or so. I did a video, I think, maybe about 2 weeks ago now, for all our client base. There's just it's hard to pinpoint why is the market selling off, and I think a lot of it has to do with two factors. One being inflation, and the Fed.
Yeah, so there seems to be a couple of cross currents that are occurring right now in the stock market and the economy as a whole. And to consider one is generally something that you can do as an investor and make decisions. But we have two, maybe three, even four different cross currents happening at the same time here. Interest rates are rising. Inflation has been high. We have the conflict over in Ukraine with Russia and Ukraine. We still have lingering effects of COVID. Right. So there's just a lot going on, and we haven't even talked about the supply chain disruption,
which continues.
Yes.
Not surprisingly, I don't guess, especially with foreign countries shutting down still because of COVID. We don't really feel the effects of that so much in the U.S., at least in the South anymore.
No, we don't. But foreign countries now, as the interdependency that has occurred on the globalization of the economies, where we receive parts to put into other manufactured goods. Right. Finalized and sold here in the United States, like automobiles, for example, receive parts from other countries.
Right. Most of them, I think. I personally don't have a whole lot of anxiety over this. I guess partially because I see it. I guess, if you're flying an airplane and you're in turbulence, you're the one driving. You don't feel it as bad as the person in the last row, right? But we have rising inflation. We have to curtail that, so we're going to raise interest rates. The Fed's going to raise interest rates. With that means the bonds are worth less, which translates into lower prices but higher yields. So that means as your bonds mature, as they get sorted through the fund, the new funds have a higher yield, which means higher income. That higher income eventually pays you back for the loss in value, but it takes years for that to cycle through. I don't know that we get that far. Quite honestly, I think there'll be another event along the way that spooks people and pushes them into bonds, dropping the yields, raising the prices, especially if the Fed raises interest rates too far and pushes us into a recession. We already have negative GDP for the first quarter, and within a couple of months or a month or so, month and a half, I guess.
Yeah.
We'll find out
the second quarter.
We'll find out about the second quarter.
Right.
But it's very interesting. Everything I read, economists believe we're not in a recession at all. No one seems to be worried about that except for the S&P 500 and the Dow.
Right. Well, one of the main reasons that the economists, who look at these things, aren't too concerned is because there's such high demand for employment these days.
Oh yeah.
Okay. So a recession is generally has to do with disemployment.
Right. That's very true.
But this is not the case. So we're having strong demand for new employment. At the same time, we're concerned about a recession. So these things are a little, up and down right now.
Yeah. I mean, you have to curtail inflation, but at the same time, wages are higher, but they're not as high as the rate of inflation. And then people are looking for jobs. Like, I don't know where all the people went. There's a lot of theories that it's your Uber driver, it's your DoorDash guy. They can make more money in a shorter time period and have more time off or flexibility by doing jobs like that versus the traditional, retail restaurant kind of job. I don't know how much truth there is to that, but that's just some of the things I've been reading. But we have to put this into perspective. I mean, yes, we have a sell-off in the market that makes people nervous to open up their statements and look at declining values. No one likes to see declining values. We're all told since we were born, especially in the U.S., that we're winners. We're all winners. And if we don't feel like a winner, we can go see somebody who will talk us into why we are a winner or give us something to take to make us feel like a winner.
Yeah.
And I say that in all seriousness because we are conditioned that we must always win. And investing is not about winning. It's about patience. It's about sticking to a plan and a risk profile and sticking to that over time. You're not going to go to cash in any market and time it right both ways.
And that's the key right there, is you have to be right twice.
Correct.
Every now and then we get to be right once, and it happens. And we pat ourselves on the back, not as portfolio managers, but investors as a whole.
Right.
It's always great to have got that stock at a low price and then sold it later at a higher price. The problem with trying to time the market, as you say, is that you're looking at these macroeconomic factors that are occurring, trying to make sense of it, and recognizing, one, are we at a high in the market, or is it going higher? Two, later on, you're looking at the market when it's low and saying, is it the low or is it going lower? And trying to assimilate all this information and make a decision, not just once, but again, twice, because if you sell, you go to cash. Later on, you have to reinvest, go back into the market. So you have to be correct on the other side as well. And if you look at it on a chart where it goes up and down, quite often just the opposite happens. People sell out of concern, fear, and the market's low.
Right.
And then when the market begins to go back up again, they wait. They want to make sure. They want confirmation. And all the while, the market is climbing that wall of worry, as we say. And then finally, when it gets them to the upper echelons of prices and valuations, people start to go back in.
Because they feel better.
Because they feel better about the economy.
Yeah.
And this is something I wrote about in a blog that's coming out. And that is, you can't make your decisions about the market on how you feel. You have to make decisions based upon what your needs are and what your investment objectives are out in the future.
Well, more importantly, you can't have all your money in the market to where if you need money, you have to go to your portfolio to liquidate. That's not how you save for your future. You have to have a cushion. You have to have reserves outside of your portfolio. So when times like this happen, you don't have to liquidate your portfolio in order to live. So it's being smart and doing planning first, then investing comes second. And so you build these buffers in, so you never have to touch that money. We're in a period now where we used to say, and this will be true in the future as well, but right now, today, you have your cash, then you'd have bonds, which is less risky, and then you'd have stock. Well, with this reset of interest rates, the bond aggregate is down almost as much as the stocks are. And so now you really can't go to your bonds to pull from there. You just really have to leave the portfolio alone and let things kind of reset themselves. Reinvest dividends. That's always important. If you have excess cash, now's a great time to put more back in. But if you're not in that position, that's fine. We've got to stop thinking with our emotions and how we feel about something with no data behind it. You can psych yourself out driving down the road with no data in front of you, thinking, "Oh man, I got to get out of this thing. I keep losing money." But yet you forget about the last decade. The last decade, we've averaged 13.5% per year.
Per year, annualized
in the S&P 500, 13.5%. And you're going to have a 13% down period in a very short span, and now you're going to jump ship. It just doesn't make sense. It's emotional investing, and you're never going to be successful at anything, ever, if you only think with your emotions. You don't think with data. We know that buying passive index funds, we know that we have a 94% chance of outperforming all these other much smarter sounding strategies long term. But it's hard to execute our style of investing, because in times like this, people want to see us go into cash. or making drastic changes. I'll make change. I'll make change when I see an opportunity to benefit from someone else's fear and emotional selling in the market, not
Sure.
someone individually, obviously,
Sure.
but in overall
we'll be
market.
tactical from time to time.
So
Absolutely.
it's, during remember during the financial crisis, we started loading up on inflation protected bonds because no one was worried about, everybody was about deflation. So you talk about deflation, start adding TEBs to your portfolio because nobody wants those at that particular time. Ended up being a great long-term play. We kept waiting for inflation. It took, 20 years for it to actually get here. But remember that ever since 2008, people are like, oh, this inflation's going to come and get us. And it took 20 years for it to, well, not quite 20, but a long time for it to show up.
Well, the famous investor Warren Buffett, who I hope many of our listeners have at least know of,
Right.
always has said, be fearful when others are greedy and greedy when others are fearful.
Oh, absolutely.
Yeah.
Yeah. And you think about it too, is everything's, what if it all goes to zero? We have 6,700 stocks in our portfolio. If those all go through chapter 7, we've got bigger issues.
I was just going to say, we may have bigger issues.
I mean,
to
it's
deal
either
with
all
if that
state
occurs.
owned at that point. It's all just state owned, or it's literally all gone to zero.
Well, look what's happened in the past 20 years or so. Look at these huge events that have occurred in our economy. We had a great financial crisis. We had a banking crisis in our economy, and we survived. Later on, we had a global pandemic. We had an illness out there that threatened the entire world.
Right.
We shut down the economy.
Yeah.
And we survived. The economy is coming back. I don't know that you can have a greater crisis than either of those two. I honestly don't.
Right.
Think about it.
In the last 10 years, we already mentioned 13.5% rate of return for 10 years. That's per year. 12.66% rate of return of the S&P 500 for the last 5 years. 13.4% rate of return per year for the last 3 years. The last year's down 4%. If you're invested in the S&P 500 plus the other things that you diversify it with, you've had a great decade. Great decade. And in that decade included 2018, we lost 18%.
Just in the fourth quarter.
Just in the fourth quarter.
Yeah.
One quarter, we lost 18%, rebounded back.
Right. And you remember, because I remember, on, I think it was Christmas Eve, the market went down 1,000 points.
Oh,
that
that's
day.
right. That's right. Yeah.
I mean, these events occur.
Yeah.
And I can't even remember why.
Right. That's true.
I mean, these things do occur from time to time in the market, and they become opportunities.
Right.
Yeah.
In 2020, 34% drop, the COVID drop. Honestly, I think their phones were ringing less then than they are now, which is a little
very
surprising.
fast,
but it did happen very fast, and I think people were
We had this thing over
about
here
their
called COVID.
Yeah, they're worried about their health, I guess.
Yeah.
And how in their own business and trying to work from home, and they were just distracted. Maybe not as distracted now, but things are going to happen in the market. And when you look at a chart, if you go back to you can go to Yahoo Finance, you can type in S&P 500 or IVV for the ETF. You go back and look at history, and you go, I want to invest in that. And that's one of our core holdings is the S&P 500. And there's other outliers that have done even better than that, like technology and things like that.
Sure. Well, one way I like to look at it, Casey, is during these periods of crisis, it sharpens business managers' minds. They learn new ways to extract every value of every dollar that they reinvest in their business.
Right.
Okay. They get better and better and better every time there's a crisis on hand. So with this recent one, they have learned a lot about how to manage their business and control their resources and get the most out of them in a period of shutdown.
Right.
Okay. And what was terrible relative to the economy. And they've come out of it, and they're using what they learned to be even better business managers in the future. So I look at these as opportunities also for our CEOs of the S&P 500 who effectively we invest in through IVV, the S&P 500 ETF, that they just get better and better and better every year.
Bottom line is it's okay to have the emotions about what's happening in the market. So how you react to it. So it's and as advisors, it's our role to keep repeating ourselves. That's our job. We know what the right thing to do is. What's bad is some advisors do the wrong thing and they encourage clients. We onboarded probably 4 or 5 clients in the last year that the advisors they said, okay, I want to liquidate, and they let them liquidate. And at some point you have to. I mean, we work for these people, right?
Correct.
It's our jobs to pay attention to what it is that they want. But it's also our job to understand what their needs are, so they don't end up in that position. And it's there is a point at which the market gets oversold. Maybe we're getting close to that. Basically we've erased all of 2021 at this point. The income or the earnings we made in 2021. So we're back to 2020 pricing. So would you invest in late 2020? I sure would have. And if we get back to, I don't think we're gonna get back to 2020 lows, but if we got back there, that's a pretty good place to invest long term too. Okay. Go look at the chart. There's these big dips right now, just like right now. There's these big dips. And then what comes after that dip is always movement upward. Doesn't mean it's tomorrow. Doesn't mean it's this year. Doesn't mean it's next year. But it always happens going forward. And you just have to be patient. Keep your costs low. Always buy that cheap index fund. Stay away from active managers. And then focus long term.
Absolutely.
And be diversified. You might pick. I don't pick individual securities for myself, but there might be some people who do, and there might be some deals out there that if you're patient that you can pick up and hold. But anyway, so this podcast was actually going to be about 10 common questions about Social Security. So we probably should get through this because that's probably what people were trying to listen about was about Social Security. Social Security, well, I don't know. Let's start. What is Social Security, Brad?
Well, Social Security was established in 1935 to provide retirement income for certain U.S. workers. It was expanded later to maintain cover the entire workforce. It was designed to help people from falling into poverty at their retirement, where they no longer had the ability to go out and earn an income. It's probably one of the most successful, if not the most successful, government program ever. Okay. It's had its ups and downs. It's had its controversies, but overall, it has done a great job of maintaining a level of income for all U.S. citizens, okay, who have qualified for it, okay, through various means. And we can talk a little bit about that. There's over 35% of elderly men and over 40% of elderly women who count on Social Security for at least half of their income.
Which is
so without this, they
one reason why it won't be going away.
That's right.
I make that point all the time to people. Oh, Social Security's going to go away. Half the people in this country, according to this, about 38 to 40% of people's country, majority of their income comes from Social Security. So you take that away, you're going to have food lines.
Yes.
You're going to have mortgage defaults.
And this is exactly what it was for, is to make sure that the least of us had at least a certain amount of income,
right,
to maintain a standard of living above the poverty line.
Right.
Okay.
What I found interesting is 12 to 15% of elderly men and women, it's at least 90% of their income. So that's even bigger, and it's probably a small amount they're getting too based on their age and when they took it. So it's kind of sad.
So now you know what it is. When are we eligible for it, Casey?
Well, you're eligible for Social Security basically somewhere between 65 and 67. So if you were born after 1960, then it's going to be, let's see. It's going to be age 67 for people born in 1960 or after, and then 66 for those born between 1943 and 1954. So probably by 1954, if that was your birth year, you're already taking or getting close to taking Social Security anyway. From 1955 to 1959, the age increases annually by 2 months. So basically, for most of us, it's going to be age 67 is when you're eligible. Now, you can take Social Security sooner. So you could take it at age 62 if you would like, but you're going to greatly permanently reduce your monthly benefits. So between 62 and 67, that's taking it early. 67 to 70, you're delaying it for 70. By age 70, you want to be taking it. There's no benefit to not taking it past age 70.
Right. And the thought is that this is really an annuity. And so on an annuity calculation basis, if you start taking the annuity early, you take a reduced amount.
Yep.
If you defer taking the annuity, because this is what primary insurance amount is called, you could defer your payments, but you get it for a shorter time in your lifespan, and you get a higher amount. Okay?
Correct.
So it's calculating that relative nature of the amount relative to your circumstance or client's circumstance and their life expectancy.
So between 67 or full retirement age. So if your full retirement age is 66 or 66 in 4 months or 6 months, between there and age 70, it increases 8% per year, the benefit, plus the rate of inflation.
Plus the COLA. That's
Yep.
right.
So this last year, that was huge. You got, if you were waiting between 67 and 70, you waited another year, you got an 8% increase plus the 6% increase.
Right. Now, a question that sometimes people will have is, if I have deferred taking Social Security, do I still get that COLA? And the answer is effectively it's yes, because the price, the payment rises for everybody, even though you're not taking it. So you have gotten, if you've deferred your primary insurance amount payment in retirement, you got an 8% increase for deferring and a 5.9 or 6% increase for the COLA.
Correct. Brad, how is eligibility determined?
Well, it's based upon a couple of different factors. For a worker, it's based upon the number of credits you have. Okay. And a credit is equal to an amount of money that's earned over a period of time in a year. So like a credit right now is $1,470. Okay. Rising to $1,510. So every $1,510 that we earn, we get a credit, and you can get 4 credits maximum a year. Mm-hmm. And in order to have full retirement benefit, okay, for yourself, you need 40 credits over your working lifetime.
Right.
Okay. So once you have that, you are eligible for your full Social Security benefit. Okay. And that can be changed based upon how much you earned during those years. We can talk a little bit about that.
Okay.
So if throughout our working years and we're gathering up our credits, earning our credits, how much are we actually paying into Social Security each year?
So basically you're paying 6.2% of your wages, and then your employer pays an additional 6.2. So it's 12.4% of your wage each year that's going in up to a certain amount. So for 2022, after $147,000 of your personal income, it's not your joint income, but your personal income, then you no longer pay into Social Security. If you are self-employed, you got to cover all that on your own. You're paying both sides. So you're going to pay 12.4% for both parties. And that's something to always pay attention to if you're thinking about going out and working on your own. FICA, you have to pay both sides of that. So as an independent contractor, you got to make sure you're getting it more than what you're making as a W-2. Another thing too is business owners tend to try to avoid that by doing an S corporation, taking a very small salary, and then taking the rest as a distribution from their S corp. And the downside to that is you're hurting your Social Security in the future. So typically, what we see with successful business owners is they're taking $150,000 a year as a base, and then they're maxing out a 401k with that, and then the rest of it goes to taxes, and then that also counts toward the 147 towards Social Security. So you get a net zero paycheck, and then above that you take a draw, which will save you on taxes long term. But ideally you want to take you want to pay into make sure you're paying into the system, because you meet a lot of older people who are hard workers, but they didn't pay into the system and they didn't save well, and so they end up in retirement with not much to show for it. So you have to be careful of that.
It's a balancing act.
Brad, do you know how much you how do they calculate how much you get?
Well, it's based upon a formula that averages the income from the 35 highest earning years. Okay, so as your income may rise over years, and if there are dips and so on, it'll average out the 35 highest years of earning that have been calculated through the Social Security Administration, and then you'll get your PIA, your primary insurance amount, based upon that. And there's a calculator estimator that can be looked at on your Social Security website, where you can put in your average years, or you will actually look at your own account and get an estimate about what you might be getting in your retirement.
Makes sense.
So can we still get Social Security while we're working?
In fact, you can, but there's a little caveat here. So if you're at retirement age, so let's call it 67 or older, then you can take Social Security and your employment income, and there'll be no reduction in Social Security. Now, Social Security would be taxed potentially, right? But you're not going to get a reduction. Now, if you take Social Security, let's say it's 62 to get that payment, but you're still working, basically it gets reduced $1 for every $2 earned. So basically in 2022, $19,560. So if you earn more than $19,560 in 2022, every dollar that you get in Social Security, or every $2 that you get over that, you would reduce your Social Security. So for most people, it doesn't make sense to take Social Security while you're still working. It's better just to delay it.
Right.
Because eventually it would go down to zero at some point. Now, retirees can contribute to IRAs if you have earned income. However, Social Security does not count as earned income. So that's something to remember. A lot of people try to put money away in Roths or IRAs in retirement, and you can't do that without earned income. And Social Security does not count toward that.
So if somebody's going to work part-time to supplement their income in retirement, it needs to be coordinated with their Social Security payment in order to maximize that part-time income.
If they're under age 67,
right.
Correct.
Right.
Typically, it's better just to take the part-time income and delay your Social Security. All right. So how does the spousal benefit work with Social Security?
The spousal benefit is a unique aspect of Social Security. It goes back to the very beginning of when Social Security was enacted into law. The idea is that in a single household earning situation, the non-earning spouse would effectively not have any retirement income if he or she didn't have any credits to their Social Security account. So they saw this and recognized that the non-working spouse still was a contributing member of the economy through raising families during that time frame. So what they decided that is for a non-working spouse without enough credits to qualify, they can qualify on their working spouse's benefit. And they can get up to 1/2 of their working spouse's benefit claimed for themselves, okay, in retirement. If they should have their own 40 credits, they will have the benefit of the higher of their half of their spouse's benefit or 100% of their own benefit. So they always get the better benefit, okay, either through their working credits or from their spouse's 50% benefit.
Makes sense.
Yeah. Well, you mentioned that Social Security, is income. So do we owe taxes on Social Security when we receive it?
Probably for most retirees, you will, especially if you're withdrawing from IRAs or you have other pensions. For a married couple with combined income from $32,000 to $44,000, you'll have to pay income tax up to 50% of your Social Security benefit. If you make more than $44,000 and you're collecting Social Security, then you'd be taxed on 85% of your benefit. If you're single, those thresholds are 25, 34, or more than 34 is 85%. So yes, so they do tax that, but it's not taxed the same. 100% of it it would never be taxed.
Right. So we're receiving it on a tax favored basis.
Correct. Mm-hmm. Right. So Brad, how do you apply for benefits?
Well, we apply up to beginning at 3 months before we actually retire for applying for retirement benefits. And you can apply at a Social Security office or by phone or by online. So you'll need to take with you or have available to you certain documents. One of them would be your birth certificate, of course, your Social Security number, and any other identification that may be needed. But you apply 3 months before you are actually planning on taking your Social Security benefit. That gives them time. Now, Social Security payment is actually paid in arrears. So if you've earned it or due it in 1 month, you're paid in the next month.
Yep.
Okay. And what's interesting is payment is done based upon our birth dates. So it's not everybody gets it at the beginning of the month. You get it throughout the month based upon when your birth date falls in that month.
Interesting.
Yeah. It used to be that everybody got it at the beginning of the month, and anybody before 1997 who was receiving it then still gets it at the beginning of the month. But after 1997, the volume of payments going out on that one day at the beginning of the month just became too large to handle. Right. So they began spreading it out based upon birth dates.
That's a very big payroll account.
It must be.
Lots of tasks.
Yes.
All right. So let's talk. I guess we kind of round this up by how does the system work? So a lot of people are concerned that Social Security won't be around.
So Casey, Social Security is a fascinating topic. I mean, how does the whole thing work?
Well, I don't know about fascinating, but it is interesting. All right. So, what's interesting is the fact that everyone thinks Social Security is going to be dead in, I think, 2033. And that's not the case. So about 76% of Social Security's need comes from taxpayers. So you and I still working, we're covering 70% of its, let's consider its monthly bill. Mm-hmm. So the rest of that comes from excess over the years. So because there are more people working than retired, baby boomers, excess funds went into the Social Security Trust Fund. There's actually two trust funds. One is called the Old Age Survivor Insurance Trust, OASI, and the other one is the Disability Insurance Trust, or DI. So by law, if you're wondering how those get invested, they're all invested in U.S. Treasuries, of course. So in the end, we're all paying. So when they started the whole system, you didn't start by putting your own money in. They save it for you and you get it back later. You immediately started paying existing retirees, and then there's no way to get off of that, right? So we're always paying for people who are already working. So this whole thing of, I'm going to get mine, I put mine in, I'm going to get mine back out.
Not really. It's not an
educated comment. No. That's not how it works at all, actually. So anyway, that being said, I guess I kind of answered number 10, which is Social Security in trouble? And I'd say it's a little complicated, but it's easily solved. Easily solved. I think politically, though, it's probably not popular to solve it today.
No. It's always been called the third rail of politics.
They're going to solve it at the 12th hour, and they're going to work in a bunch of other stuff that has nothing to do with solving Social Security. We know this for a fact.
Yeah.
But basically, it can pay its full benefits through 2023, but after that, only 76% would be available, right? And so what are some ways we can solve that?
Well, I think one way that they've looked at, and it is estimated to solve over 90% of the problem, is to eliminate the salary cap.
Mm-hmm.
Okay.
Yeah, that 147.
147.
Just let it keep going.
Just let it keep going. Okay. And that would solve, almost over, I saw as high as 98% of the problem. This is a couple of years back, but that's one way of solving it.
The only downside of that, though, is that a lot of people who that would apply to would never receive that back out of the program.
Never get their money back.
No. Mm-hmm. And so that in today's politics, that I think people will be okay with that. But in the past, I would say that you'd be pretty upset if you're never going to extract that back out of the program.
Right.
Another thing they can do is always, they could take away the 8% to, benefit to wait. They could change the retirement age. They could say 70s now, full retirement, right? Mm-hmm. They could means test it. If you have assets above a certain amount, you can't receive it. There's a lot of different ways to do it, but removing the cap probably makes it the simplest
probably so
way to solve it.
Or
but there's no reason
to taper it off, hitting a
correct.
inflection point where it begins to taper off.
And I would be totally against that right now, because if you're going to do that 10 years before it's supposed to go out, that money is not going to be there in that trust fund. They're going to spend it. The money should be in the trust fund, but they keep borrowing from it and they don't put it back.
That's right. The Treasury has borrowed from it from the very beginning.
So you got to wait for it to go to zero. When it goes to zero, then you solve it. But that's my 2 cents. Okay. Well, those are 10 ways or 10 common questions we get about Social Security, with about 15 minutes of comment on why you shouldn't be selling in a down market.
Right. And
use this opportunity to reinvest dividends, invest more. Heck, if you're still working, it's your favorite store on sale. Keep investing. Focus long term, and these are the periods when you get rewarded because of the pullback and the price. So, thanks, Brad.
Thank you.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening, that way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore. Wiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.